Okay, we'll get started then. So today's webinar is all about ethical investing and doing more with your money. So there's also, chose this picture here. You can see with the piggy banks, and I thought there's a nice analogy there, or a nice anecdote story about piggy banks. I don't know if everybody's aware of their history, but it's something that originates over 600 years ago when people would use clay pots to store money, and the clay was called pig, which was spelt P-Y-G-G, and it was around the time of the Saxons where it was actually pronounced pug. They used to pronounce the Y with a U sound, and it later changed to the same sound as the animal pig. And apparently the animal pigs would roll around in pig mud and dirt, and so people storing their money in clay pots made out of pig, when they started calling them pig, they started asking, or well, English potters apparently started shaping the pig pots in the shape of the pig animals to humour the words and the connection between the words. And as that trend grew, I think in those days you probably wouldn't call it a viral trend, but today you might call that a viral trend. It became popular, and people actually began requesting the pig clay pots to be shaped as pigs. So it's not about, we're not talking about investing in pigs or pig farms or anything like that, but there you go, that's what the history behind the piggy bank. Okay, so let's have a look at what we're going to be covering today, and a little bit about myself and our business, Balanced Wealth Planning. So we're a firm of chartered independent financial planners. We're based in Nottingham. We have clients all over the UK, mainly around Nottingham and the East Midlands. We've been in operation for about 6 years now, so fairly well established, and we've been winning a few awards. We've won the top 100 of UK financial planning firms for 3 years in a row, which is a nice accolade to win. A couple of other awards there as well, vouched for Sunday Times top 250 financial planners as well. I myself have been involved in financial planning for 20 years now, since 2001, and I've been a financial advisor since 2009. So fairly well, long time in the profession. I worked for small, large companies and seen it all. Okay, so I'll be taking you through today's webinar. As I mentioned earlier, it's Earth Day, so we go restore our Earth. There's a theme for today's Earth Day. If you want to know more about that, then please do go and have a look at earthday.org. There's a lot of information there about it. If you want to get involved, there's more information there as well on how you can get involved. And hopefully next year, when we're out of the pandemic restrictions and hopefully into some sort of new normal, we may run some events ourselves, and you're welcome to get involved, so keep an eye out for those. So today's contents will cover: what is ethical investing all about? Understanding your objectives, matching values to investments. So how can you actually achieve your objectives in terms of your personal and financial objectives, but also your values? We'll look at some myth busting, greenwashing, which is quite a big thing to watch out for, especially when something is gathering the momentum that ethical investing is. And there'll be some actions to take away and things to think about moving forward. So what is ethical investing all about? Well, there's some interesting quotes here from, this one's from the London Stock Exchange from a few years ago now, and but it's still quite relevant today. I mean, it says here that, you can read it there, that it says, once upon a time, ESG factors, which is commonly a jargon term known as environmental, social and governance issues, were often a niche interest among people that were involved in the investment world. But it's not anymore the case. It's gathered a lot of pace. It's been around a long time, but it's been gathering a lot more momentum and a lot more pace, and investors themselves now are routinely looking at information on the criteria for where their money is being invested and what's actually going on. So it's it's designed to help people understand and gain a better understanding of an individual company's future prospects in terms of where they might be going forward. Let's see. Just had a buzzer come up. Okay, so we've got somebody, I think that's just somebody joining, that's fine. Okay, welcome for any late joiners. You've not missed much. This webinar is incidentally being recorded, so we will upload it, so it's available to view back as well, if you want to look at it again. And so what's all the fuss about when we talk about ethical investing, and why is it gathering so much momentum and pace? Well, we're seeing that global inflows into ethical investment products, not just funds, but all sorts of products, rapidly rising. In 2020 alone, we think there's a view that this has been accelerated in part due to the coronavirus pandemic. It's allowed people time and space to put a spotlight on this area. Inflows into ethical funds have sort of more than tripled in 2019. In the first half of 2020, they're topping records that have been previously the high records. There's been a drive from consumers also because, well, interest rates have been next to zero for such a long time now that people are looking at ways of investing for returns. And then with that comes the inevitability that people want to look at ways of matching their investments to their values. But besides investors, which are a big part of the picture, authorities and governments around the world are driving integration as well, and looking at the risk and sustainability factors through regulation, and they're mandating changes through regulation as well to drive this forward. Pension funds in the UK are playing their part as well. There's a government target that they want public sector sort of pension funds to help play their part in achieving the net zero target by 2050 for greenhouse gas emissions. So there's an increased interest going on here. The increased interest is coming in from all sorts of areas because people are looking at companies that better manage their social issues and how they treat their employees, how they work within their communities and their environment, and so on. And there's a growing belief that sustainability or sustainably managed companies with strong governance that are doing the right things are also better investment prospects, that they'll have less risk going forward as well. So let's look at some key terms here, because there's a lot of jargon when we talk about this sort of subject. We've talked about ESG, we've talked about ethical investing. There are other terms as well: socially responsible investing, green investing, impact investing, social impact investing. So there's a ton of different terms used in relation to the topic, and often the terms are interchangeable, but they can also mean different things to different people, which makes it no surprise that the jargon is often misused or misunderstood. But I'll try and break this down to give sort of my definition of these these headings. So ethical investing, I'd say at its core, it's really relating to using one's ethical principles as the main filter when choosing which companies or sectors to avoid investing in, which is known as negative screening. And that's traditionally how it started. But of course, since then, it's developed to now include positive screening as well, which basically means that you can choose companies or sector that you actively want to invest in, that you believe match your principles, typically promoting and encouraging a positive ethos in some way. And SRI, known as the Sustainable, Responsible and Impact Investing, or Socially Responsible Investing, involves investing in companies that do good by being considerate of people, communities, and the wider environment. Then you've got the phrase green investing, which is a form of SRI, I would say. It's generally used in reference to investments made with companies that promote environmentally friendly practices. And no doubt we'll start to see blue investing as well, that forms alongside that. So companies that promote environmentally friendly practices to do with the ocean and the seas. Then you have impact investing, which has the intention of generating measurable and beneficial social and environmental impact alongside a financial return, and that's usually focusing on a specific theme. And then you've got social impact investing, which is probably a subset of impact investing, I'd say, with a focus of using investments to generate social returns as well as financial returns. And I'd say the UK, we're fortunate here because it's probably got the world's most advanced social impact investment market. There are social problems that cover all sorts of things such as health, aging, homelessness, unemployment, and really these areas are, as I say, very targeted and specific to allocate investments to tackle specific areas, and usually in specific geography as well around the country. And then you've got ESG, that's probably the most commonly known phrase, the environmental, social, and governance. And I'd say ESG is probably an umbrella term that really covers all the other 5 headings as well. But ESG in itself is really, it's business data that's collected and then mapped to its ESG data. So it's about using the data and using that alongside other financial metrics and qualitative data as well that provides fund managers a deeper understanding of the risks and opportunities available within an investable company. But the main challenge here with all of this jargon and all of these terms is there's no one-size-fits-all approach to ethical investing. And since the term ethical in itself means something different to everyone, there's no shared industry standard approach either. The ethical ESG fund offerings vary considerably as well. So there's a big difference between what you might class as an ESG fund and what areas they're targeting amongst the funds. I mean, there are now, I think, over 2,500 ethical funds that span all sorts of different areas. So there's a lot of information and a lot of things to sift through to find something suitable. Just the challenge is quite immense. I mean, you can think about companies like, for example, Tesla at the individual stock level, and one fund may be happy to have an allocation to Tesla because they'll praise them for reducing society's reliance on the traditional internal combustion engine. You may find others that score Tesla low and maybe not include them because they're worried about the reliance on dangerous and difficult to recycle lithium batteries, or the fact that Tesla is a big investor in Bitcoin and the impact that Bitcoin mining has on resources and electricity and so on. So there's a lot of challenges as we'll go through, and you'll see a little bit more about that. So this ESG ratings is a model provided by the index provider, the FTSE for Good index. And I would say when funds look to screen individual stocks for ESG, they tend to break that down into various different criteria and then categorize those into headings which they'll sit under either environmental, social, or governance. So you can see things like environmental will inevitably include things like climate change, but it will also look at things like water security or biodiversity. Social will look at things like health and safety, human rights, labor standards, and so on. Governance is looking at tax transparency, which we often see in the headlines, corporate governance, and anti-corruption. So ESG in itself, I would say it's gathering the data and then categorizing that data and trying to score that data to see where each company scores in these different areas. And how the data is used can vary widely. I mean, there are several issues, as we mentioned. There's, first of all, there's a lack of data. I mean, it's getting better, but there is a lack of data. Only a small minority of companies report sufficient measurable data at the moment, so that is changing. But, we could do with that accelerating as well. Fund managers tend to use rating services as well. So the rating services then have their own way of scoring the data. And that can vary in itself and is a controversial area in itself as well. As I mentioned, Tesla, there's other examples like, for example, Shell. Some rating companies may score Shell quite highly because they would say, well, Shell is a big investor in alternate energy production, and others may score them quite low because of the oil impact that they have in the world, so the reliance on traditional fossil fuels. And then the fund managers themselves can take differing views as well on which companies should or should not be invested in, and how much they should be invested into those companies. So the weighting that those individual companies have. So there's a lot of variation there between what the investment funds themselves, the fund managers, ratings companies, and it's trying to understand what's actually going on underneath that that's important and how that matches to your values. Now, at some point, some of you may have seen this chart here and come across this before, but at some point in your sort of journey in ethical investing or ESG investing, you'll no doubt start to come across this more and more now, which is the United Nations Sustainable Development Goals. And so this is a 2030 Agenda for Sustainable Development adopted by all United Nations member states back in 2015. And it provides a shared blueprint for peace and prosperity for people and planet, not just now, but into the future. And at its heart, there are 17 Sustainable Development Goals, as you can see there, which are all an urgent call for action by all countries, developed and developing countries, in global partnership. And they recognize that ending things like poverty and other deprivations must go hand in hand with strategies that improve health and education, reduce inequality, and spur economic growth, all the while tackling pressing issues like climate change and working to preserve our oceans and forests and the planet. And the SDGs build on decades of work by countries and the UN. It was written originally for governments and policymakers, but it's now stretching beyond this and into the investment and asset management world. And interestingly, back in 2019, the United Nations declared that we only have 11 years left to prevent irreversible damage from climate change. So 2 years on, of course, now we are down to 9 years left, and it depends how that's either being pushed back or accelerated forward, depending on the actions of as individuals and countries and nations globally and collectively and individually. So that's quite an interesting area. But the UN SDGs here, as you can see, it's being used, as I mentioned, by investment and asset management companies and the industry, the financial services industry. And we're seeing increasingly that individual companies and funds cross-referencing their ESG ratings and the ESG areas with the Sustainable Development Goals. And we believe that that's quite important because the SDGs provide the framework and lens that allows investment companies to be mapped to the areas of impact that they have by using their data. So you can see things like the solution, if it's clean energy, the UN SDG area would be affordable and clean energy. Things like enabling infrastructure would be sustainable cities and communities, and so on. And the more transparent and readily available individual companies make their data, and the better that will feed through to fund managers when they construct their investment funds and portfolios. So the main point I would say the takeaway with this is that all of the terms and labels represent values. So it's important for you as an investor to understand what you want your money to do. And it's important for us as financial planners to understand what values are important to you, so we can then try to match your money to your values where appropriate. So, understanding your objectives. Well, let's have a look at in the context of financial planning for a moment. And so the primary goal of investing into the financial markets and the stock market, it's defined as maximizing your return while minimizing your risk. And so, I would say before you go rushing off to invest your money into the latest shiny ethical fund, you need to look at a few things first. So we need to take one step back before we move forward. And so financial planning is looking at your personal goals and objectives in life and matching that and looking at how do your finances, because money, you may have heard us say this before, but we have a belief here, a balance, that money is simply a tool to let you live the life that you want to live. And so we need to understand the kind of life that you want to live and what your goals are. And then we can say, okay, what's the purpose of all the investments? What's the plan? Because without the plan, you're just really aiming anywhere. And so we need to make sure you've got clearly defined personal objectives first. And that will help to determine the sort of risk that you need to take, the sort of returns that you need to achieve to meet your goals. Because one of the first goals should be financial security. So we need to understand risk. And so we need to understand the impact of where you allocate your money and the risks involved with that. And then we need to look at, should all of your investments and all of your money be invested in an ethical way? And can it be invested in an ethical way? Is it as simple as that? So I've created a little sort of flow chart here that looks at a starting point to think about this. So one of the first questions to ask is, well, are issues concerning people and planet important to you? Now, and this is in the context of thinking about your investments. Of course, if you ask that question generally, everybody will say yes. But in the context of your investing your money and your wealth and your pensions or investments, wherever they are, is that important to you? And if it isn't, some people take the view that don't want to do that. That's fine. You would just invest normally in a non-ethical or non-ESG portfolio. And those people may take the view that they just want financial security to be their main priority, and they want to just invest normally. And we'll talk about, what does normal investment mean? What does it look like? How does that? Because that varies between financial planners, between asset managers. There's also differences there as well to understand. But people will take the view and say, look, I just want to invest normally, low cost, just get the market returns, and then I'll use my own money to do good in the way I see fit. So I'll donate money to charity, or I will use my own wealth in other ways to make an impact in society and the world at large, which is fine. But if you want to allocate your money to an ethical sort of investment, then you have to accept a few things. At the moment, ethical investing is far from perfect. So do you accept that it's getting better, and it will get better over time? But it isn't perfect yet. So, and what we don't want to do is, use perfection to stop progress. So that's one principle that you have to sort of accept. And then the performance and the risk experience will be different to non-ESG investments, inevitably, because you're tilting your portfolio, you're changing your portfolio. You may hold less investments, you may be less diversified, you may be allocated to certain geographies more than others, and so on. So that journey, that investment journey, will be different. And are you prepared to accept that? And also the ESG measurability will vary as well. So returns and risk is one aspect of it, which we can measure year to year, depending on the output of what's happened, and compare that to a non-ESG portfolio to say, look, how is it performing? How is it doing? Is it doing what it needs to do? Is it affecting you negatively in any way when we do our modeling? But the important thing is that once you've invested in something that's ethical, is can you measure the impact that it's having? And at the moment, that's another area that's in its infancy. So actually thinking about, if a portfolio has been invested, let's say it's £1 million portfolio, what impact is that having in the world? What impact is that having in carbon, on the carbon footprint, and so on? What about collectively as a business? If we're allocating people's money as a business and pooling that money together, what impact is it having collectively? Is it even measurable that way? And if you're not, and if you don't accept those principles, or you don't want to accept those principles, then you can invest again normally and use your wealth in other areas, as I mentioned, donate to causes, and look at ways of making changes in other areas of your life. But if you want to look at that and you accept those differences and those principles, and you think, okay, that sounds reasonable and I'm happy to invest my money in this way, then we'll look at what your options are. So it's about matching values to investments. And so we've got this chart here, which is often referred to as the spectrum of capital. And so the question is, should you invest all of your money or some of your money in an ethical way, and which sort of areas should you invest in? So whatever the answer, as I mentioned, first we need to work out what values are important. Do you want to make a little difference or a lot? Are there any particular areas that are important? Do you want to have a negative screen, such as avoiding things like weapons and arms or tobacco manufacturing, or other areas that you definitely want to encourage more action, such as climate change or women's rights or equal rights? And are these goals focused locally, nationally, or globally? And where do you want this impact to happen? And as I say, you're prepared to make some compromises. You know, there's no holy grail yet, and the picture is changing rapidly. And you know, there's different ways of doing things. As I mentioned, you've got your traditional investments, you've got some responsible, sustainable investments that look at some screening. You've got impact investing, which thinks about return first. So there may be some green bonds in there or thematic funds. And you've got the impact investing that looks at impact first. So there may be an impact there in terms of a bigger impact socially. They're more outcomes driven, but there may be a difference in the returns that you generate and the impact that has on your financial planning and your financial journey. And then beyond that, we're starting to talk about philanthropy. So, you know, donating money. And do you want to donate money to causes or ventures that will have an impact in the areas that you want to target? You don't really expect a financial return here. You know, you may just be something that you're happy to donate a portion of your money away in the knowledge and belief that it's going to make a difference somewhere. So you've got purely profit driven on one hand and purely social on the other hand, and where you sit there or how you allocate your money there is something that we need to think about. Oops, let's go back a bit. So following on the flow chart, yes, if you want to look at these and you believe in those principles, then there are a few different ways of doing things, and this is how we would tackle it here at Balance. So we would say maybe think about using a light ESG sort of tilt on your framework. So it looks at aiming to keep the risk and return profile as close to what we would call the normal portfolio as possible. So your investing journey doesn't change radically. So that will have a light screen on it. It's not very targeted. We expect a similar journey, but not the same. And again, the score, the measurability score for the ESG outcome, and the values and how that's having an impact in the world is going to be fairly low with that. We're not going to be able to see what sort of impact that's having as yet. The other option is you can invest in a normal non-ESG portfolio and then allocate a portion of your capital to a specific focused area that's important to you. So you can say, okay, for the bulk of my financial planning, I don't want to take a different journey than a normal portfolio is going to give me. But what I want to do is carve out a portion of my wealth, whether it's 10% or 20% or whatever it is. We would help to work out what's a reasonable amount with some of our modeling that we would do, and say, okay, that's not going to have an impact on your financial planning, and you can target that specifically in something that's, you know, much more aligned with your views, and your outcome from that may be more measurable. The output from the ESG measurability should hopefully be higher. I would say it's probably still low to medium, because the data isn't as available yet, but there may be some good data depending on what you target. Different areas are more developed than others, such as climate change and so on. So you still make a difference, but in a slightly different way, and it's more specifically targeted. Or you could do a bit of both and have the best of both worlds. You could, on your main portfolio, have a sort of a light screen on there. So most of your investments and taking that light screen approach, and then you've still allocated a portion to the more targeted approach, and you would see how that works. And if the targeted approach generates you profits, then great. You could either reallocate that back into something else, or you can, but if it doesn't, you know that, okay, it's not going to impact on your financial journey. And of course, whilst doing all of this, you can continue making changes in other areas, because one of the things to watch out for with ethical investing is, because it's so popular, it's becoming almost like a feel-good business in itself. And in that, it means that people may think, okay, well, look, if we just tick the box there, it becomes a bit of a box ticking exercise. We invest our money in this area, and we've done our bit, and we don't need to do anything else. And there's a danger there that, if pension funds or companies think like that, or even individuals, if we think like that, then it means that we may not be taking other actions in other areas that also have an impact. So things like, continuing to support other organizations that need support, recycling more, walking more and using less fuel and using less plastics and so on. And so those areas shouldn't be overlooked as well, just because you're thinking about ethical investing. And hopefully the measurability scores start to improve over time, and the data becomes more available, and we can actually measure the impact that collectively the capital is having out in the world. And when we talk about planning and why it's important to think about that in the context of your own personal financial journey and situation, we utilize something here. If you've worked with us already, then you may be familiar with this, but if you haven't, we use something here called cash flow modeling. And so working with a financial planner not only helps you to explore and prioritize your goals, both in terms of your personal and life objectives and goals in life. What does your income expenditure profile look like? What do you want to achieve going forward? But it also helps to understand what risks are, what the risks are, and how much risk you should take, and stress testing your plan to say, okay, where are the areas of concern? What do we need to watch out for? And taking that all into context, it will then allow us and help us to match your money with your values. So the key thing for most people is, to make sure they don't run out of money in their lifetime. And so stress testing really helps to look at things like that. But it will also allow us to look at, okay, if you invest ethically, is there going to be any particular risks there? Is the portfolios that you're investing in any more risk or any less risk? And what happens in those scenarios? I mean, what we are seeing, there is evidence out there that shows that at the individual stock level, companies that generally are run well and have good governance and therefore score fairly high on ESG scores from rating agencies tend to perform well and have less issues in the future, because they have a good culture and the business is run in a good way. So that should translate into better returns. The evidence isn't quite there yet for investment funds yet, because funds are so variable. You're getting a fund manager picking, thousands of different companies to invest in at different portions and different weightings and making changes. And so there are a lot of variables there to see if taking those variables into account, are those risks and returns translating into a better journey through investment funds. And that's where the sort of the dangers may lie. And so this modeling is very useful, because it helps us to look at things like the market crash that we had last year, the pandemic crash. If you were somebody that was invested in the stock market, you'll have seen that your portfolio would have dropped. And if you've been working with us for a number of years, you'll have seen that we stress test for things like market crashes routinely in advance of them happening, because we know that they will happen at some point in the future. You just can't predict when. But stress testing for things like that in advance really helps, because it allows us to look at things objectively and informs us of what we need to do if that does happen, rather than trying to tackle that situation if it happened at the time. And so using that data, we can look back and say, okay, how have investment funds, non-ethical funds versus ethical funds performed? Did they perform better on the downside as well as the upside? The tricky part is nobody has a crystal ball to predict if that's going to continue through the future. What we want ideally is a journey like this, where you have a good probability of success and everything is blue. There are no red areas there. So let's look at some myth busting now. As I just mentioned there, do you need to sacrifice financial returns for ethical values? And that's, so it's probably a big myth here. I mean, there's one issue is that there's a lot of information out there for a start, and too much information creates what we call green confusion. That green confusion allows a lot of myths, it fosters myths, and it allows companies and fund managers to start looking at, start greenwashing and even blue washing now. That will be a phrase that you'll probably hear. But as I say, that it is probably a myth that ethical investing delivers low returns. I mean, it's not the case. Sustainable growth is a necessary ingredient to ensure the long-term growth of a company. So a business that does have strong ethical or environmental, social and governance practices will avoid unexpected risks and obstacles further down the line. And that research is now coming out to start showing that case. As I say, at an individual company level, that's certainly true. We just hope that starts translating in through to investment funds. And so it's showing that not only does it help to reduce risk, but it can also help them to increase returns. And I think, if you think about it just at a high level, companies that tend to do well will attract more investment. Companies that have got bad practices or the bad PR around any of their ESG areas will tend to, investors will pull their money from those. So they don't only stop using their products and services, but at the investment level, people will want to avoid those companies. So it's not just to screen out the bad guys, but to encourage the good. So ethical investing means choosing funds that just screen out unethical choices only, which is no longer the case now. As the data becomes more available, as I said, you can start allocating capital to those that do good. One myth is that people often think, oh, well, this is some, it's a fad, it's something that's for sort of millennials or hippie types, and it's not really the case anymore. There's, as I say, it's a big area of interest now amongst everybody, amongst sort of a lot of clients are looking at this. I mean, there was a study done a while back from the government that claimed that over 70% of people that they'd spoken to want to invest their money to do good for people and planet. And that was in a Investing in a Better World report, which was done a couple of years ago. So I'd say that those figures, if they test those again, have probably gone up. You need lots of money to invest. So people think, well, okay, how much money is my portfolio really going to make a difference? Is it going to make a difference? Because even if you think of a portfolio, whether it's 100,000 or £1 million, if you're spreading that investment across tens of thousands of companies and you're only holding a small percentage in each company, how much influence and impact is that really going to have? And if you translate that across through to the actual investment fund that you're in, how much influence does a fund manager have when they go to these board meetings as a shareholder, and do they have that? And you don't really need that. I think collectively, if people are pooling their money together, there's more influence, there's a bigger voice there. But also, so you don't need a small amount to invest. There are a number of investment options that it's not really limited by the size of your investment, and collectively it will start to make a bigger difference. So it's too expensive. Well, that's subjective. I mean, if you're comparing sort of ethical investing versus your traditional passive low cost investing, then there may be some increased costs, because inevitably there's fund managers that are doing additional work to screen companies and engage with companies and look at what they're investing in, what not to invest in, and so on. But if you're comparing it sort of like for like with a traditional active non-ESG portfolio versus a traditional active ESG portfolio, then the fees are on par with each other. And so, and the sort of rise in low-cost passive ethical funds is increasing competition as well, which is helping to keep costs down. So there's a lot of work going on in that space. So number 6, it's too complicated. So with ethical investing, I would say now it's firmly in the mainstream. So it's never been easier to find resources to help you make better financial decisions. Of course, we would always recommend you seek professional advice before investing. But there's a lot of resources out there and information out there. We're trying to help by doing things like these webinars, and you can speak to us individually if you need to understand more and you want to understand more about your own particular views and how they may reflect in your investments. But it's getting more and more easier to understand. There's still a way to go. As I said, there's a lot of terms out there, a lot of terminology. There needs to be some more consensus amongst the fund management industry, financial services industry, amongst governments and nations and so on, but it's getting better. So is it too restrictive? Is it restrictive? I'd say it's not too restrictive. As I mentioned before, to maintain a competitive advantage, if you think about an individual company, the directors and managers there, they have to respond to a growing demand from consumers. And recent studies have shown that in America alone, if you look at the S&P 500, the top 500 companies there, that around 90% of them are now actively reporting on ESG risk factors voluntarily. So that's good news, because it means that if the companies are reporting on these, then it's not as restrictive as it once was, because they know that in order to attract investment, they need to be transparent with these things and need to be actively engaging with these things. And number 8, is it an all or nothing approach? As you've seen before with our sort of flowchart approach, it's not a binary choice. You can combine traditional non-active, non-ethical investing with ethical investing. It just depends what's right for you. And is it higher risk? Well, the nature of ethical investing can result in a smaller investment pool. And so it depends on how stringent that criteria is that you apply. And so, of course, diversification, which is often referred to as the only free lunch in investing, is about spreading your money across a number of different investments and in a number of different companies, global sectors, regional sectors, and so on, so that you're not essentially putting all your eggs in one basket. And if you narrow that down, then of course that may increase risk. So it's about understanding what's right for you. And as I say, taking a target approach may be better than having all of your money in a restricted pool of investment. If you get the balance right, the evidence is beginning to show that companies that that invest in that tend to do better will do better, and it shouldn't really have an impact on risk any more than a non-traditional investment. And I think we've covered it won't make a difference with you need lots of money to invest. So just to touch on that point, large businesses, so the ones that make up the biggest portion of portfolios in a portfolio, they are the ones that make up the largest part of the global stock market. So we're talking about the Amazons and Facebooks and Googles of the world, and they have to react to consumer demand. And so to maintain their position, they must adapt to changing consumer attitudes and behavior. So I think it does make a difference. Okay, so let's look at the topic of greenwashing, which is also known as green sheen, although you may not hear that as often. But essentially, it's a form of marketing spin. And I would say that if something looks green and shiny on the outside, it's important to look under the bonnet to see what's actually going on. We need to look beyond the label to truly understand whether an individual company or a fund manager is really, are they living their values, or are they simply paying lip service as a marketing gimmick? feel good industries like ethical investing is a big business, and even accreditation companies that they may run a sort of a pay to play model where you can only get the accreditation that gives you the stamp of approval, but what sort of checks and balances are there to ensure that the companies that are being accredited are actually living the values? Morningstar published something quite recently which was interesting. They found that 1 in 6 ESG funds are retrofitted from existing, often struggling strategies. So what do we mean by that? Well, you've got traditional active investments, and active investments are under pressure already from fees, because their fees are higher. And so with the growth in passive investing, low cost index investing, active investment strategies are struggling to maintain their justification for their high fees, particularly where they are not outperforming the market, or they may be underperforming the market, or they may just be closet trackers. They may just be tracking the index anyway, tracking the market, but charging you a higher fee to do so. And so ESG has become a way for them to keep hold of those high fees. And that's what this study is really showing here, that if they're struggling, an easy way to not struggle, easy way to maintain your investment inflow into your fund is to market yourself as an ESG fund. That's a very real form of greenwashing going on. 25 portfolios reborn as sustainable funds. Now, it may be that the fund managers have changed, or the mandate of those funds have changed, and they're actually looking at making a difference and thinking, okay, look, this wasn't working. We're actually genuinely doing something about it and doing something different to use the money that we've got invested currently in this fund and change the mandate to an ESG mandate. But I would really look at that, look at the reasoning behind that and what's going on. The other question is, with 2,500 funds, do we really need any more? I'd say there's probably more than enough out there already. So how can we spot what's going on? And partly that's what we do. That's our role, is to look under the bonnet for you as an investor to see what's going on and recommend something suitable. But it's looking at things like, if a company or an investment fund is spending more time and money claiming to be green through things like advertising and marketing than actually implementing business practices, then you probably want to avoid them. There may be companies that say a lot and do a lot, and they don't actually live the values. Interestingly, BlackRock, if you've ever heard of BlackRock, they are the largest fund manager in the world by size. They came out not too long ago. The CEO came out and said that they want to integrate ESG as a big part of what they do as a business. Ideally, they want to run everything as ESG portfolios and make that the default, which sounds great, because as the largest fund manager with trillions and trillions of dollars and pounds of money allocated to companies around the world, they have a big part to play. And very recently, stories started coming out from within the business of bad practices in terms of equality and how they treat their employees and the culture within the business. And so it just goes to show that, if companies are saying one thing and other different things are going on, we need to really understand what's happening here. At an investment fund level, it means checking the board to see who they are, what they're involved in. Does the company have a corporate social responsibility policy? Are they walking the talk, or are they just trying to greenwash? Are they wasting resources by traveling around to conferences around the world when video calls will do, as we've seen quite well over the last year? It works quite well in all cases. Are they a diverse company? So are they actually living those social values? Are their governance values right? Are they tax transparent? Are they paying their fair share of taxes? And so we need to look at that, and we need to be aware of costs, because cost as an investor is probably one of the only things you can control. And so it's important to understand the impact of costs and higher costs and how that compounds over your lifetime. So that's some areas of how to spot some of the greenwashing and what we can do. So some actions to take away. So think about what your goals are. So in terms of think about when you're thinking of financial planning, where do you want to get to? Are you planning for some sort of retirement? Are you saving to buy a house? Are you you want to help children get on the property ladder and so on, and thinking about what your goals are in life. Are you working? If you're working, when do you want to retire? Do you want to stop? Do you want to phase retirement? What do you want to do with your time and your resources, and how does that work in the context of your financial planning? And then think about what values are important to you. So really have a think about that. I mean, we are in the process of launching a ethical questionnaire that will really help you to understand what's important in those areas. So keep an eye out for that. We will announce that when it's launched. It will be an online questionnaire, which will be a fairly interesting way of looking at things, we hope. It's something that we've been developing for a while now, because as you probably gathered, this is an area that's important to us as a business and as individuals within this business. We all believe in these values here. And so think about are there other areas in your own lives where you can make a difference, and what else can you do yourself individually? Can you go down from 1 car to 2? Can you recycle more? Can you walk more? Can you eat greener, and so on? And speak to independent financial planners like us that specialize in sort of comprehensive holistic planning and have a good understanding of investing for good and how that works. There are some financial planners out there that will just say, oh, you want to invest ethically? Great, here we go, here's a fund for you, and then off you go. And as I say, it's really just understanding, is that the right approach? Are they just doing it as a box ticking exercise because they're earning fees as well, and so on? So you need to look at what's going on and who's doing what and why they're doing things. A little bit about us, as we mentioned there, that's where you can find us, balancewealth.uk. You can email us, team@balancewealth.uk. We're available for video calls at the moment. So, there's a lot of members of staff. You can see more about us on our website. So we'll take some questions. If you've got any questions, use the Q&A function, please. But I had a question come through in advance, which I'll give my thoughts on. So I'll read the question out, and I'll sort of just disseminate that down to some of the key areas that I think are important here. So the question is, when thinking of ethical investing, we tend to think of mainly environmental, ecological, health and welfare issues, including smoking, arms production and the like. Does the category also include any of the financial engineering models which would appear to be equally unethical, thinking particularly of some of the practices which may or may not occur in hedge fund activities with the 5 and 20 remuneration level? So the 5 and 20 remuneration model is a model where to invest in a certain hedge fund, and I'll explain what a hedge fund is in a moment, but to invest in there, you have an entry fee of 5% of your investment, and then they charge a performance fee of 20%. And so it's quite expensive to get into it. And what do hedge funds do? Well, hedge funds are sort of closed investment vehicles, if you like, where you're pooling your money, or you're giving your money to a hedge fund manager, and they're really employing all sorts of different strategies which are very obscure. You don't know what's going on and what they're doing underneath. There may be short selling strategies there where they look to make money by betting that share prices go down and so on. And there's even reports of hedge funds doing insider trading and so on, and all sorts of things where they're looking to gain an edge and perform well because their fees dictate that. If they're charging 20% performance fees, then of course they want to perform. And so how did they do that? And those sort of financial engineering models at remuneration level, is that an ethical concern? So I would say that in terms of financial planning, first of all, when you speak to financial planners like us, we tend to only look at regulated investment products and services. So if something's unregulated, we won't ever use that. It has to be regulated in the UK by the Financial Conduct Authority. And we like to keep things simple here. So we would never use complicated things like hedge funds in our planning, because they just don't, most clients have no need for these things in the context of their financial planning, first of all. And so really you have to think about that falls under governance. Thinking about the remuneration model falls under governance, but more closer to home in terms of financial planning, you should be asking questions like, what are the remuneration models like at the fund managers and the fund houses? How are they remunerating? How are they remunerating their staff? So not only what are the costs to you as an investor, and even businesses like us. Financial services is not always had the best reputation. And that's because if you think back to before 2013 and 2012, when the Financial Conduct, at the time, the Financial Services Authority brought in a new regulation called the retail distribution, where they changed the way people pay for their investment advice, where you were no longer able to pay, use commissions, where firms weren't able to earn commissions from recommending certain investments and products. Had a big impact, because before then, and you see why banks had a lot of mis-selling and so on, because the staff members there are incentivized to sell certain products because they have certain amounts of commission. So as a consumer, how do you know you're not being recommended something because the person recommending it isn't earning a commission or a fee from it? So there's a conflict of interest there. And thankfully, that's no longer the case. But equally, it doesn't mean that remuneration models aren't important. For example, here at Balance, all members of staff are paid a salary. There's no, if there's a bonus structure in place, if we pay a bonus out every year, it's dependent on the business and how the business does across various measures, not just profitability. But no one individual is targeted to say, okay, look, if you generate X amount of revenue in fees, you're going to get X amount of bonus, because that doesn't really set the right culture and the right way of doing things. That's our belief. Others may take a different belief, other businesses, but we want to set the culture right from the outset and from within. And so when you look at things like hedge funds and fund managers, you have to think about their governance practices and their culture, and see if they apply decency limits and caps on their fees. And the second part of that question talks about some of the more lightly regulated private equity investing, such as businesses being acquired by private equity. And often with private equity organizations, when they acquire a business, there's a practice of loading them with debt, which can create issues. There can be underinvestment for long term, leading to company failures, as you've pointed out in the question. Things such as Debenhams and Southern Cross care homes, as you've mentioned there. And so is this going to create an issue socially? Because what you're asking here is, with ballooning government, corporate and personal debt in recent years, not least because of COVID-19 pandemic, and any increases in future inflation and things like that, is that going to create issues where institutions that are investing in these and taking advantage of private equity will be fine, may be beneficial for them, but for small groups of investors, and wider pool of investors, and for consumers who the businesses ultimately rely on, how are they going to be impacted? And I think this is more of a question around the sort of structure of capitalism, again, because businesses like ours, financial planning, and what we do not ever recommend investing in private equity vehicles. There are certain vehicles that you can invest in that that are like private equity, which are like venture capital trusts and seed enterprise investment vehicles, where you're investing in startup businesses, but they're very high risk and they're not often used. There's government tax advantages for those types of investments, but this is a question about the structure of how businesses operate and the framework in which they operate, which becomes more of a sort of a talk about capitalism and how that sort of corporate capitalism structure is working in practice. And I would say that again, as information becomes more readily available, stories get more published, public are more aware of these things, there will be a shift inevitably in the way private equity chooses to run their organizations and chooses to run how they invest in things, because ultimately the goal of the private equity company, if you like, is to invest in something and generate a profit. That's their sole aim, is to buy something and make money out of it. And so the practice of how they do that, and whether they do that in a sustainable or an ethical way, will start to get more scrutinized, I would say, over time. So I would hope that those practices become more equitable, more fairer for everybody involved. But inevitably, in any capitalist structure, you're going to get businesses that go out of business, and businesses that do well, and businesses that take advantage of these things, and that's the nature of the way the global business, free market enterprise operates. So let's have a look, as we're touching over an hour now. Let's see if there's some more questions here. Are we sharing the slides? They're great. Well, thank you for the feedback. Yes, as I say, we'll share the slides. There will be a recording of the webinar. What rating services might I look at to get some idea about specific funds that have been recommended to me? So if you have some specific funds, I would say that you can look at various different things online if individually. I mean, if you've not got a financial planner, we could do that kind of work for you if you're already a client of ours and work with us. We can happily look at that to see what's going on with those investment funds. Otherwise, Morningstar, it has some good resources there. So if you look at Morningstar and you type your fund in there, or if you can get your fund code, because each individual fund will have a specific code that reference that, you can type it in to the Morningstar search bar, and then they will come up with a sustainability section there. They have a free area there. Now, it's very technical. It's not, it's designed for people that sort of look at this thing more often, regularly, and sort of the more financial services sector. But it will give you a sustainable area of that fund, and it will give you an idea of what's going on there. So there's that. There are some other areas, maybe other investment platforms that will also start to score. So if you're a direct-to-consumer investor where you're not investing through an advisor, companies like Interactive Investor or AJ Bell, they are sort of whole-of-market platforms that allow you to invest in investment funds from across the market, like what we have access to as advisors. There may be funds that are not available through them, that are only available through the advisory market, but for the most part, if you have a look through there, you'll find that if you look for your fund on there, they may have a scoring for an ESG rating there to see what's going on there. So it's just having a look around to see. But again, it's just understanding the way that that's being rated and who's rating it and how they're rating it. The other easiest way is to get the fund fact sheet itself. So the fund that you're investing in, look for the fund fact sheet from the fund provider and see what information they provide. And no doubt, if they are strong and positive on their ESG work that they're doing, they will be shouting about that. So you will see what they are saying, and they will tell you that, look, at us, we're doing really good. If they don't tell you anything, then it's either a non-ethical fund or the ethical score is quite low. So just bear that in mind. Next question, does ethical investing make a difference when you're invested in the perfect market? Great question. Okay, so the perfect market. Well, first we have to define what is the perfect market. And so I'll take a slightly different approach here. So we talked about you've got a traditional non-ethical investment portfolio. Well, what is that, and what does that look like? And so we're talking now about sort of modern portfolio theory and portfolio investment construction and how this all came about. And in a nutshell, when you're investing like that, what you're doing is you're investing your money globally, typically across global equities. So we're talking about individual companies around the world that are listed on stock markets, and potentially global bonds. And so that's how a traditional portfolio is constructed. The bond part is different to equities because bonds are there to, that's money that's being lent to corporates and governments to provide an interest and security of capital. So it's not really there to provide a return, but it's designed to be not correlated with your equity. So typically what happens is, and you see this last year when the markets crash, when equity markets crash, bonds tend to perform well. So it limits your risk, it limits your downside, and how much you allocate, whether it's 50-50 or 20-80 and so on, depends on your investment profile. Now that global portfolio is invested according to what we call the market capitalization of the company. So what do we mean by that? We're saying how big is that particular company in the context of the global stock market and in the context of its own stock market in America, for example, or in the UK. So if you look at the FTSE 100, taking it back home to the UK, you've got the top 100 companies in the UK, but they don't all equally provide the same level of return, and they're not all the same size. And so some companies are vastly bigger in terms of their impact and their return in that 100 list. And so they have a bigger portion, they have more of your money is allocated to that individual company. And that's how the traditional investment portfolio is constructed in that way. Now, what will happen, in my view, is as these ESG areas become more public, more well-known, more money is being allocated to these areas, naturally we'll start to find that the companies that do well by doing good and do well financially and perform well and attract investment in will be the companies that do good and genuinely do good. They're not going to be greenwashing. They're not going to have as many risks and issues going forward, and they're going to be living those values because that's the culture that they've instilled in their organization, and that will flow through. So naturally, that perfect market will be companies that are always going to do well. And yes, okay, we're talking, that's an ideal scenario. That means getting rid of things like arms and so on. Is that ever going to go away? Probably not. But you may find in that global makeup that those companies have less of an allocation now because they've attracted less money. They become smaller businesses as that in that global picture. And so that should then translate into having an actual difference in the world, because there's companies that are doing well. It means that they are more environmentally responsible, more socially responsible, have better governance practices all through their supply chain. And no matter what industry they're in, no matter what they're doing, they should perform well across all those measures. So I would say that it will make a difference. Whether the market's perfect or not, it will start to get better. Okay, next question. Are there any government incentives to ethical investments? There is specifically the social impact investment taxation. So when we talk about impact investing, when we look on that spectrum of capital, there's an area of investment that is not very well known that you can invest capital in, where it's specifically targeted to certain themes and areas, like I mentioned, homelessness or unemployment. And there's a tax subsidy provided by the government there of around 30%. So this, what it does is you invest your money into this in the hope that you'll get a return. But because these are these are non-profit organizations that you're investing in, so these are real businesses, they're specifically targeted. And because the government wants to foster this, they were talking about stopping this tax incentive recently, but they've renewed it again for a few more years. And I'll add some more information about that to the slides before we send those out. And yes, there are tax incentives there to ethical investments at that level. So that's a specific area where you can say, okay, I want to invest, some capital to tackle, say, homelessness. And one of the best things about that type of that investment is that you can actually meet the businesses, because it can be targeted to areas that you live in or that you've grown up in or that are important to you, or just an area that you think it needs the investment. And you can go and meet these businesses and these investments on the ground and see what they're actually doing and see the difference they're making in the world, in their communities. If you want to, you can get involved with them, voluntarily help out and boots on the ground and get stuck in. So it's very, very good. I like them because of that aspect, that the measurability of the impact is high because you can see what's going on. It's not something obscure where you've put your money into the stock market and off it goes to do its thing, and you can't really measure it or see what's going on or the impact it's having. And so that's a positive area, but it's not very well known, and I hope the government continue to support that. I think other incentives to ethical investments, yes, I think the government will start looking at these sorts of things as time goes on, but it's a case of watch this space. Okay. So that's all of the questions that we have today. So I hope you've all found this useful and helpful to get you thinking about things. As I say, we'll get the slides sent to you all. The webinar will be recorded and published, and you'll get a notification for that. If you have any further information or any further questions later on, feel free to contact us, and I'll do my best to answer those as well. Okay, it's been great having you all join me today. Thank you. Okay, bye-bye.